The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, Roth Conversions and Rollovers. The webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. Before I turn the floor over to Linus, we are going to vote on the June webinar. And as a reminder, on May 6th, we will discuss life insurance and charitable LLCs. So mark your calendar for that one. The topics up for your consideration for the June webinar are reviewing a client's income tax return, dealing with missed RMDs, or IRS updates 1099-R reporting for qualified charitable distributions. I'm going to go ahead and launch the poll and give everybody a minute or so to vote. All right, we got about 10 more seconds to get those votes in for anybody who is interested. All right, it looks like the June webinar will be covering reviewing a client's income tax return. And with that, I will turn the webinar over to Linus.
Welcome, everyone. I'm pleased that you've joined us for today's webinar titled Roth Conversions and Rollovers. Today's session is part of our webinar series. Each of these webinars is open to those in the life insurance and financial services industries and is free of charge. Before we begin, I'd like to remind you that next month's webinar will be held on Wednesday, May 6th at 11 a.m. Central. The topic will be life insurance and charitable LLCs. If you know of a financial professional who might be interested in one of our monthly topics, feel welcome to invite them to join us. Today's webinar will last approximately 15 minutes. Let's get started We certainly can't cover everything that there is to know about Roth IRAs and designated Roth accounts in our short time together this morning, but I've picked a few things that Jennifer and I get asked pretty regularly. We'll start with talking about Roth conversions. We'll discuss briefly the difference between designated Roth accounts and Roth IRAs. We'll talk about rollovers and the clock that applies to rollovers from designated Roths to Roths IRA. We'll touch on backdoor Roth, and then we'll discuss the two 5-year rules that seem to confound many of our callers. So let's go ahead and talk about Roth conversions. I think Roth conversions in 2026 and beyond will continue to be something that our high-income clients will be interested in thinking about. The motivation in a Roth conversion is to take advantage of relatively low income tax rates today in order to achieve a positive income tax result in the future. Roth conversions typically are done from traditional IRA to Roth IRA. When somebody does one of those, the amounts that are converted are taxed at ordinary income tax rates, but there's no 10% pre-59.5 penalty tax on the amount of the conversion. And the goal is, as a result of the conversion, to get ultimately qualified distributions from the Roth IRA. What are qualified distributions? It's a distribution that passes two tests. The first test is there's 5-year aging of the participant's first Roth IRA experience. That means that if, for example, a contribution was made into a Roth IRA for calendar year 2021, the 5-year clock starts January 1st of 2021, and somebody will have already met that 5-year aging test here in 2026. So the 5-year participation clock is one test. And then the other test can be satisfied in one of three ways. First, the person is older than 59.5. Second, the person has passed away. Or third, the account owner is disabled. If any of those three are met, the second part of the test is passed. And so if both the 5-year test and the second part of the test are both passed, distributions from a Roth IRA are income tax free. Now, when Jennifer and I get callers, they often talk about Roth accounts, and they don't make a distinction between a designated Roth account and a Roth IRA, and they are definitely different. So a designated Roth account is very similar to a Roth IRA, but it's governed by different rules with regard to contributions and also different rules with regard to distributions. Designated Roth account is a feature in a new or existing 401k account, 403b account, or governmental 457b plan. The plan document would create this special designated Roth account as part of, for example, the 401k account. The funds may or may not be accessible. The accessibility of the funds are governed by the plan document. Usually when somebody has separated from service, they have access to their designated Roth account. If they are still in service, generally you have to check the plan document to make sure that somebody has access to their money and can do a rollover or take a distribution. For Roth IRAs, a few things to know. We talked about them a little bit already, but Roth IRAs are allowed to accept rollovers from designated Roth accounts, but you can't roll over a Roth IRA into a designated Roth account. It's possible for a taxpayer, if the taxpayer is eligible, to maximize contributions to both a designated Roth account and to a Roth IRA. And what do I mean when I say somebody's eligible? Well, it means that somebody's below the income thresholds for making a Roth IRA contribution, and they are eligible to participate in a designated Roth account at work. And then one other thing is that after 2024, RMDs are no longer required from designated Roth accounts. So now Roth IRAs and designated Roth accounts have a common feature in that RMDs are not required while the account owner is alive. Once the account owner is dead, if we've got a non-spouse beneficiary, both an inherited designated Roth account and an inherited IRA would be subject to the same 10-year rule that typical traditional IRAs are subject to where somebody died before the required beginning date. Let's talk about rollovers and the clock. And again, Jennifer and I get asked about this often. So the question arises when somebody is going to roll over a designated Roth account into a Roth IRA, and the client and the advisor want to know whether the aging associated with the designated Roth account will carry over to the Roth IRA. So for example, let's say we've got somebody who's 45 years old, separated from service, it has been a participant in a designated Roth account for more than 10 years. And the question is, if they roll over that money into a Roth IRA, will the 10 years of aging from the designated Roth account carry over? And the answer is no, it does not. The clock starts fresh if the client has never had a regular Roth IRA experience. There are a couple of pieces of good news though, and that are these, right? So if somebody takes a distribution from a designated Roth account after 59 and a half and after having met the 5-year test, whether they take the distribution or roll the amount over into a Roth IRA, all of that money, because they've met the tests, all of that money is completely tax-free. And so for those who have substantial money in a designated Roth account who are older than 59 and a half, they shouldn't really be worried about rolling over designated Roth money to a Roth IRA in most circumstances. One other piece of good news is this, and that is that while the aging doesn't carry over from a designated Roth account when that money is rolled over into a Roth IRA, the reverse works in our favor. And that is if someone's had a regular Roth IRA for more than 5 years and they roll over designated Roth money into the Roth IRA, the designated Roth money automatically gets the 5 years of aging from the original Roth IRA contribution that's been more than 5 years old. So that's a piece of good news and a reason for our clients who have designated Roth accounts to consider also creating regular Roth IRAs so they can take advantage of that aging in anticipation of a future rollover. All right, let's talk about another popular topic. Let's talk about backdoor Roth IRA. I think it's best to think about an example here. Let's say we've got somebody who's aged 52, making $500,000 of adjusted gross income, a single taxpayer. That person would not be eligible to make a regular Roth IRA contribution. They would like to do it, but they can't do it because they're over the income threshold to be eligible to make a Roth IRA contribution. However, the same taxpayer could make a non-deductible traditional IRA contribution. There are no income limits for those types of contributions at all. Somebody can make $1 billion a year of earned income and still be eligible to make a non-deductible traditional IRA contribution. And so in this example, we've got the taxpayer making $500,000 a year, makes an $8,600 non-deductible contribution to a traditional IRA, and let's also assume that that's the only IRA that they've got. Same taxpayer immediately converts the traditional IRA to a Roth IRA. And so if the conversion occurs on the next day after the traditional IRA is funded, the conversion would be completely of after-tax money, and there would be no tax associated with the conversion, and the effective result is the taxpayer would have contributed $8,600 to a Roth IRA, even though they weren't eligible to make the contribution directly. Now, that's how it works in a perfect world. You should be warned that if the taxpayer has pre-tax IRA money, it doesn't work the same way. So let's say that we've got the same 52-year-old who's got a traditional IRA of pre-tax money, 100%, that's worth $91,400. Let's say that it came from a rollover. So that's the pre-tax money. The taxpayer tries to do the backdoor Roth IRA technique, tries to segregate a new $8,600 contribution of after-tax money into a separate IRA, and then tries to do the conversion of just that IRA consisting of all after-tax money to a Roth IRA. Well, under those circumstances, the IRS says, not so fast. The IRS says you've got to aggregate all of your traditional IRA positions for the purpose of figuring out how much of a conversion is pre-tax and how much of it is after-tax. So in this example, we've got 91.4 of pre-tax IRA money. We've got $8,600 of after-tax IRA money. Even though those monies are in separate IRAs, the IRS says, no, you got to mash them all together for the purpose of figuring out how much of the conversion is taxable. And so in this example, only 8.6% of the conversion would be tax-free. The under 91.4% will be taxable if the client tries to do a Roth conversion under these circumstances. So be aware of that. You certainly want to coach your clients who are thinking about doing that kind of thing and make sure that they don't have any pre-tax IRA money if they're thinking about backdoor Roth. And if they do, that they're aware of the consequences that part of the conversion is going to be taxable. All right, let's talk about 2 5-year rules, because there's a lot of confusion about this. We get asked about this all the time. So the main 5-year rule is the one we talked about already, which is that if you've got 5 years of aging on a Roth IRA, and if you're older than 59 and a half, everything you pull out of any Roth IRA anywhere is going to be income tax free. That's the main 5-year rule. But people see stuff online and get confused about this second 5-year rule. And the second 5-year rule, the special 5-year rule, has to do specifically with post-conversion distributions. And this special rule applies only if all 3 of the following conditions are met. The first one is the taxpayer is younger than 59 and a half, right? If the taxpayer is older than 59 and a half, the special rule will never apply. The second thing is the taxpayer has done a Roth IRA conversion. And the third thing is the taxpayer younger than 59 and a half has done a Roth IRA conversion, and within 5 years of the conversion, the taxpayer takes out the converted money from his or her Roth IRA. Now, if all of those 3 things are true, the converted amount that's distributed is not subject to income tax because it was taxed at the time of conversion. But the distribution is going to be subject to the 10% penalty tax. The IRS doesn't want taxpayers to use conversions, Roth conversions, as a way to circumvent the 10% penalty tax. So that's the reason for the special 5-year rule. And it's a special rule that causes a lot of confusion on the part of our callers. So what are the things that I hope you take away from today's session? Well, I hope you take away everything. But first of all, I think designated Roth accounts and Roth IRAs create some opportunities for income tax planning for our clients, particularly our clients who are worried about tax rates for them being higher in the future. Well, they ought to think about Roth conversions if they're candidates. There are some intricacies associated with Roth conversions and rollovers. You should be aware of them. You should educate your client because they have the potential to affect a client's decision-making process. And then finally, be prepared to give the example that I gave. I hope you found it helpful to you. When your client asks you about the backdoor Roth strategy, it's something that certainly you should be prepared to discuss with them to decide whether it's something they ought to pursue or whether it's something that doesn't really fit for them. So I'd like to thank you for joining us today. As a reminder, if you'd like to receive the supporting materials associated with today's webinar, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's content. Feel welcome to join us for the next webinar on the first Wednesday of next month, May 6th at the same time. Next month's webinar will be titled Life Insurance and Charitable LLCs. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this month. And finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.